This conference will now be recorded.
Okay. Stop.
This conference will now be recorded.
Hello, everyone. This is Jay Kaeppel, jayonthemarkets.com. Trapped here in quarantine, I've decided to go the video route. So the purpose of this video is just to give you some idea of a few of the things that I'm looking at on a historical basis to see where we might be headed. A couple things I need to point out. Nothing that I'm going to say is a recommendation or investment advice. There's lots of risk in investing in anything. And I don't know. Time to stop.
This conference will now be recorded. This conference will now be recorded.
Hello, everyone. This is Jay Kaeppel of jayonthemarkets.com. And in this video, I'm going to give you an overview of some of the things that I'm looking at in the market that maybe you can use to help you going forward. Nothing that I say should be considered investment advice or a recommendation. This is just for informational and educational purposes only. And always remember that any kind of investing involves risk. Okay, let's start with the big picture history lesson. Here we see the Dow Jones Industrial Average on a logarithmic scale going back a little over 100 years. And what we see is, in the long run, the stock market goes up. That's the good news. The bad news, of course, is that as we were reminded in the first quarter of this year, a lot of bad things can happen along the way. It can shatter investment plans. People planning to retire, and all of a sudden their 401k is a 201k, and plans have to change. Also, it can affect your decision making for many years to come. So how do we know what to expect? Well, there is no way to predict or pick tops and bottoms with uncanny accuracy, but we can get a perspective on things. And one of the ways to do that is price to earnings ratio, price divided by earnings. What I like is the Shiller PE ratio, and you see the calculations that go into it here. Basically smooths earnings out over a number of years. So we get a chart that looks like this. It swings from undervalued at the lower end to overvalued at the higher end. Generally speaking, 10 or lower is considered undervalued, and a PE ratio above, say, 21 is overvalued. Very important point. This is not a timing indicator. It is a perspective indicator. Let me tell you what that means. A recession is the economic equivalent of jumping out the window. The PE ratio tells you what floor you're on at the time you jump. So if you're on the low floor, maybe not so bad, but if you're on one of the high floors, things can get pretty bad. Let's take a look at the bull markets. You see low valuation in the 20s, 30s, 40s, and again in the 80s. In the early 1920s, the market was very undervalued, followed by the roaring 20s, and the Dow went up over 400% in 8 years, a terrific rally. 1932, the market got extremely undervalued, and something that a lot of people don't realize is that right in the heart of the Great Depression, between 1932 and 1937, the Dow gained 330% in 5 years. During the 1940s, both during and after the war, the market was undervalued. That was followed by an 18-year 1,000% move by the major averages. And then again in 1982, very similar. Several years of undervaluation was followed by an 18-year bull market with, again, about 1,000% gain. Now let's take a look at the bear markets. 1929, you see the PE ratio peaked out, and of course we had the great crash in the beginning of the Depression. 1929 to 1932, the Dow lost 89% of its value. Following the rally in the 1930s, market peaked, the PE ratio peaked in 1937, and the market lost 49% in just 7 months. Similar to what we've experienced in the first quarter of this year, a short, sharp decline. 1965 was very different. Market topped out and then went sideways for 17 long years. Along the way, you had drawdowns of 20, 30, and 40%, 17 years sideways before the next bull market. And then, of course, in 2000, the P ratio was astronomically high and the market topped out. The Dow lost 39% in 2 years. But that wasn't the real story. The real story at the time was the dot-com bubble burst, the tech bubble burst, the biotech bubble burst, and the NASDAQ index lost 83% of its value in just 2 years. In 2007, we had an interim peak. And you can see here that stock market went down 54% at about a year and a half. So where are we now? Well, we were at a very high level, above 30 in the terms of the PE. And I had been, in presentations that I've been giving in the last year, I've been talking about the fact that there's something bad out there that's going to happen that we need to be prepared for. Well, came probably a lot sooner than a lot of people, myself included, really expected. So where are we now? Well, following the most recent decline, as of March 30th, the PE ratio was at around 24, so we're still not even undervalued. So from a big picture standpoint, if the PE ratio were to get down to 20 or 15 or even all the way down to 10, here's what the market would have to do from the March 30th, 2020 close of 25.92. For the PE to get down to 20, S&P would have to decline about 17%. To get down to 15, it would have to go down significantly more, and so on and so forth. Now remember, there's no prediction built into this. I'm not saying any of these things are going to happen, but this does point out the fact that there may still be significant risk in the market going forward. Another big danger for investors, in the last 10 years, the buy and hold method became very popular because, you know, the stock market always goes up. But after the 1929 peak, market went sideways for 22 years. 1965, market went sideways for 17 years, and the peak after the peak in 2000, 13 years sideways. Again, I can't predict that this is going to happen again, but it is a danger. The idea that the easy money that we got used to making in the last 10 years, that type of market may not be coming back anytime soon. So we have to make perhaps a different plan. Another point of concern, I call it the decennial pattern. And this really concerns us for about the next 2 years. In my book, Seasonal Stock Market Trends, I wrote about the quote unquote average decade. And the average decade has the early lull, the mid-decade rally, the 7-8 decline, and the late rally. And we're going to focus on the early lull. So let's go to some charts. Here we see the 1980s. And if you look in the red box in the lower left, you see a bear market decline in 1980 and again in 1982. The early lull. You see the mid-decade rally, the 7-8 decline, and the late rally. Fast forward to the 1990s, the early lull, we saw a bear market, a sharp decline in 1990. And then you see how the rest of the decade played out. 2000 to 2009, well, we had a full-fledged bear market in the first couple of years and a much bigger 7-8 decline than in the previous decades. And then finally, in 2010 to 2019, we saw some bearish activity in 2010, 2011. And now here we are at the start of a new decade, and it has not been pretty so far. We already have had our early lull. Now here's a little stock market history / mystery lesson. Let's look at the first 2.5 years of a decade that starts with a presidential election year. We're talking about January of 1900 to June of 1902, and January of 1920 through June of 1922, and so on and so forth, every 20 years, with the latest cycle period starting January 1st of this year. If we look at the previous 6 periods in this cycle, what do we notice about the numbers in the far right-hand column? They're all negative. So the implication is that if history is an accurate guide this time, we will not see the December 2019 close again for some time. In other words, the market may be still down significantly by June of 2022. Again, not a prediction, but a historical tidbit to consider. Here we see the cumulative chart that you bought and held only during these 30-month periods every 20 years. And you can see typically not a great time for the stock market. One other thing to focus on. So we've been talking about history. Let's talk about the here and now. Let's look at the trend as it stands right now. On this chart, from the upper left clockwise, we have the Dow, the S&P 500, the NASDAQ 100, and the Russell 2000 index. And of course, all of these indexes are below their 200-day moving average. And the most important thing I want to point out is these moving averages have rolled over and are starting to trend down. Now, if the markets decide to rally, these things can turn right back up and everything's fine. What we need to be concerned about, though, is let's take a look at 2008 as an example. If you look at the red arrows, when these moving averages started to roll over, and then the averages themselves, the indexes themselves tried to rally back to the 200-day moving average and then failed, and the moving averages kept trending lower, this is not a good thing for the stock market. So you want to keep a close eye on the trend of these 200-day moving averages. If they continue to trend lower, you want to be careful with what you're doing in the market. One last thing I want to talk about in terms of trend is what I call bellwethers. I follow semiconductors, the Dow transports, the inverse of the VIX, which is ticker ZIV, and the value line unweighted index. And here's what we saw. In early 2020, the semiconductors confirmed the new highs by the major averages. So that didn't give us any real information. However, the Dow transports topped out really in early 2018. It did not confirm by making a new all-time high. Ticker ZIV, the same thing, topped out a number of years ago, did not confirm the Dow or the S&P making a new high. And the same thing with the broad 1600 stock equal weighted value line index. So this is good information to keep an eye on these when they don't confirm. So at this point now, we would be looking for the major indexes, say the Dow and the S&P, to be making new lows, while some of these did not. But we're going to have to wait for that to play out. But this is another thing you might want to keep an eye on. Okay, that's enough of the bad news. Let's take a look at some positive developments. I wrote a couple of articles recently about something I call the JK HighLow Index, and really it's just taking Norman Fosbach's work and Gerald Appel's work and multiplying the two together, and we get this arrow, or this set of lines that goes from 0 on up. And basically the way it works is when it gets below 5 and turns up, that constitutes a quote unquote buy signal for the market. On this chart, we see one in 2016 and another one in 2019, and we did get one in late March of this year. So what does this do for us? Well, let's take a look at those two signals I just showed you. On the bottom clip, you see the JK HighLow getting down below 5 and turning up in early 2016, followed by a terrific rally over the next 2 years for the stock market. Then, of course, in December 2018, we had another big decline in the market. This indicator got very low, turned up, gave a buy signal, another great rally for the market in the next 12 months. And now we have a news signal late in March. So if we were only looking at this one indicator, we might be bullish. How bullish? Well, one of my favorite sites, sentimenttrader.com, picked up this study and analyzed it a little more closely. And on the left-hand side in the red box, you see the signal dates since 1987. And on the far right-hand column, you see how the NASDAQ composite performed in the following 12 months. And what we see is 100% of the time, the market was higher 12 months after the signal. And the median gain was over 35%. So again, if we just looked at this one indicator, well, that's a pretty good sign that maybe we should be taking a look at the stock market. Another thing that's very useful is market thrust. You think of the stock market as taking off when it really starts to go, it takes off like a rocket. Once again, Sentiment Trader, from them, they did their own study, and what they found is the S&P 500. Looking at those stocks, when 75% of the stocks in the S&P 500 are up, and the up volume for the day is 75% of the volume is in the up stocks for 3 straight days since 1940. Again, if you look in the lower right at the red arrow, what you see is 100% of the time the market was higher 12 months later. So again, if we just look at these two indicators, we can make a case for being pretty bullish on the market over the next 12 months. Let's go back to big picture analysis. The most consistent long-term trend that I know of is the old sell in May and go away. Buy at the end of October, sell at the end of May. Here we see the Dow Jones Industrial Average, the price performance, bought and held November 1st through the end of May, every year since 1949. Now you see the sharp decline that we just experienced on the far right. No way to candy coat that, no way to sugarcoat it, but we have seen things like this before, most notably in 2000 to 2002. And if you look closely, you can see the 2008 decline. But in the long run, the total gain, 8,535% through the end of March of this year. Now, when we compare this to the performance of June through October, selling at the end of May, I'm sorry, if we bought and held only end of May to the end of October, our cumulative gain since 1950 would be only 34%. And you can see it's kind of a roller coaster affair. During every decade, there are years where June through October does very well, but the long-term results are pretty stark. Buying and holding November through May, 8,500%. June through October, 34%. There's no reason to believe that, at least in my mind, that just because this period was a kick in the head doesn't mean that this won't continue to work very well going forward. One other thing I want to point out, this is going back to the, I call it the dead zone, June through October. You look at the red spikes drawn here. Every decade, there seem to be some years where it does very well and it makes a lot of money, but then you can see what happens in subsequent years, June through October. So again, I can't predict. I can't say for sure that's what's going to happen in this case, but personally, I'm looking for some trouble June through October over the course of the next several years. One safe haven to consider is intermediate term treasuries, also short term treasuries. Very low volatility, very steady performers, even in a bear market. Even in a rising rate environment, short and intermediate term treasuries can still perform fairly well. So this is an equity curve buying and holding intermediate term treasuries only during June through October since 1981. See a nice consistent return, especially when you compare it to the S&P 500. And again, what you notice is the S&P can do very well, but it's these black lines, these harrowing declines of 20 to 50% that you really try to avoid when you can. Let's talk about mid caps. It's my favorite space in the market. November through May, from 1981 through 2020, the S&P 400 mid cap index has gained over 6,000% versus only 2,400 and change for the S&P 500. Now, for the record, the mid cap index has gotten clobbered in the most recent period, even more so than the S&P 500. But I'll talk more about that in a moment. Right now, I want to go back to the consistency of that. I call it the power zone, the sell in May and go away. We're going to look at the most popular benchmark, the S&P 500 index. Since 1972, if we bought and held the S&P 500 index November through May, and we did that every 5 years, what percentage of time would it show a profit? And the answer, 100%. And that's the kind of consistency that I look for. You can see it here, 100% 5-year rolling returns positive during November to May, only 64% if held June through October. Is this unique to the S&P 500? Well, let's look at the numbers. We looked at the S&P 600 small cap index and found the same kind of thing. Looked at the mid cap index, the S&P 400, 100% during the power zone, not so good during the dead zone. Also looked at a number of different indexes, momentum, equal weight, so on and so forth. Bought and held only November through May for 5 years. Every single one of these showed a gain 100% of the time. Once again, I can't guarantee that that's going to last forever, but if we're looking for a consistent trend, it's tough to beat 100%. Okay, and finally, a couple trends to watch in the years ahead. And like I said, I can't predict anything, but I can see cyclical patterns in the market that go back and forth, and I'll show you some charts, and you can see what you think. One of these is U.S. stocks versus international stocks. For the last 10 years, the U.S. has been a phenomenal outperformer versus just about anything else. On this chart, the blue line says that the U.S. stocks have been outperforming over the last 5 years if it's above zero, and that the internationals have been outperforming if this blue line is below zero. And what we notice is a very definite back and forth nature. US outperforms for a period of a number of years, and then internationals take control. And we can see at the far right, the US has been leading for some time. So I don't know when this change will take place, but I am looking for a reversal and for an opportunity to commit a little more money to internationals versus US domestic. I mentioned mid cap versus large cap. And the reason I mentioned mid caps are my favorite, the reason is this: I think that's where the growth is. I look at the mid cap space as small cap, formerly small cap companies on their way to becoming large cap companies. In other words, that's where the growth is. Now here we see rolling 5-year return for the S&P mid cap index minus the rolling 5-year return for the S&P 500. Now we see in these red boxes of periods where mid-caps have underperformed. And what we notice is that it underperforms for a period of time. And then at least going forward, looking at the past, you get some serious outperformance from mid-caps in the years ahead. So you see the question mark at the far right-hand side. The question is this going to reverse? When is it going to reverse? And the answer is, I don't know. But what I do know is that when it does reverse, and it's been trending in one direction for quite some time, when it does reverse, I would look for a strong period of outperformance for the mid-cap index and mid-cap stocks. And then the last thing, kind of going way off the beaten path, the thing that nobody likes to talk about, commodities versus stocks. This is the performance of the Goldman Sachs Commodity Index divided by the performance of the S&P 500 Index going back to 1970. You see a back and forth nature. What do we notice at the far right? They are giving commodities away. And again, I cannot predict when this will turn, but my guess is that at some point it will, and we'll have a very strong period of outperformance. Now, one thing to note for the quote unquote average investor is nowadays there are many ETFs, DBC, GSG, just to name two broad commodity ETFs, um, that allow people to participate in commodities without having to trade commodity futures. And the last chart is the 5-year rolling returns for these two indexes, and this really shows you the pronounced back and forth nature of this relationship. And in fact, on a 5-year rolling basis, it's actually started to turn. So again, I don't know what's going to happen, but I can see that this is a back and forth relationship. So I am keeping a close eye on commodities in the years ahead. And so that's it. So I want to thank you for sitting through all this. Hope you're doing well. Stay safe and take care.